As we approach 2023, many business owners and executives are thinking about what the new year will bring. Topics such as recession, supply chain instability, raising labor costs, and inflation are at the top of their minds. In a recent Forrester survey of U.S. business leaders found that many are holding on to optimism. Most leaders across business functions expect at least some increase in overall spending next year, while many also anticipate spending more on talent and technologies. Lessons from early in the pandemic, when investments in digital innovation paid off, while blunt, across-the-board cuts did not, have clearly taken hold. Yet 2023 will not be 2020, and will require businesses to plan differently from before. In this video, we will cover our top recommendations for accounting planning for 2023.
These are the best next steps to get your accounting plan started and your business prepared for 2023. A quick note before we dive in, the action items we will discuss can and should be addressed more frequently than once a year. Consider how to incorporate regular financial touch points with your team throughout your business year. We'll make some recommendations on that too. Set up a meeting with your financial advisory team to start your 2023 plan. This might be your internal or outsourced finance and accounting team, members of your advisory board, or a combination of both. The goal is to include people who can help with both strategic planning and reporting on actual results as the year progresses, so that you can track against your plan. Establish a cadence of meetings with your finance team and identify relevant reports and metrics. We recommend at least once a quarter. Monthly is ideal, but that can depend on how changeable your business or industry is and how much feedback you get through day-to-day operations. Identify your top KPIs and review them as part of your finance meetings. These can change depending on your organization's priorities. Keep them to only meaningful metrics. These take time and energy to prepare, so metrics that don't add value to your decision-making shouldn't be part of the conversation. A great way to identify valuable KPIs is to consider what questions you ask yourself about your business that you don't currently have good answers for. For example, if you're a service-based business, you may want to measure and monitor metrics like staff utilization levels, how much time your staff spends servicing clients and generating revenue versus doing administrative work, or profitability by customer or service type. This helps identify customers or service types that might be more cost than profit. If you are a retail-based business, you may want to measure and monitor inventory turnover, average order value, or your contribution margins by product. How long does your inventory sit around, and which products add the most to your bottom line? These are valuable decision-making tools.
This will help you establish your 2023 goals. You can't plan where to go if you don't know where you're at. And make tax preparation as painless as possible. Review your balance sheet. Many business leaders ignore the balance sheet in favor of the income statement, but the balance sheet is very critical. Optima's year-end checklist can help with that. We'll put a link in the video notes to the checklist. Make sure your income statement presentation, general ledger, follows best practices, is meaningful to you and your company's leadership. If not, discuss how to improve with your accounting team. If cash flow is or may be a concern and you don't have a cash flow forecast, get one now. Why is it important for CEOs and owners to understand their balance sheet? For example, do you know what your total cash and total debt are, and whether you will need to obtain a line of credit to finance the upcoming year? How much inventory is sitting on your books as cash on the shelves? Do you have a good working capital ratio? Or are you having issues collecting your accounts receivable?
These are distinct from each other. Goals are where you want to take your company in 2023, and your budget is your plan to get there. Keep in mind that economic bellwethers are indicating more economic hardship for 2023. Supply chain challenges and inflation should be considered when developing your budget. These factors may require you to consider increasing prices on your products or services, or whether to plan for more lead time when ordering inventory or equipment. Considering factors that are unique to your business, keep in mind whether you plan to launch additional products or services. What resources will that require? Above all, make sure your assumptions are realistic. Your budget should be more attainable than aspirational. A budget that your organization has no hope to achieve doesn't do you or your team any good.
Once you understand revenue, discuss any new headcount requirements to hit the revenue targets, increase in business development efforts, marketing and advertising, and if any current space and equipment needs any increase in headcount. Ensure that the changes from previous year are realistic. Review any financing needs to support the additional spend, whether it be debt or equity financing. Prepare a profit and loss statement, a balance sheet, and a cash flow forecast. The cash flow forecast should be at least for 1 quarter. What does your organization need to cut? Build up cash, cut expenses, raise prices? Create strategies to accomplish this. Review your operating expenses, such as your variable and fixed spend. Examples of variable spend is your marketing, bank fees, payroll, subscription users, and your benefits. Examples of fixed expenses are your rent, depreciation, and your utilities, assuming that no increase in office space is needed, and other admin costs. Most companies' biggest expense is payroll. If you're a service provider that bills clients on an hourly basis, you should review the utilization of your employees to ensure that they are billing the appropriate hours to not only cover their costs, but some of the overhead expenses. Also, review your systems and processes to see if there are areas where you can implement a new system, procedure that will decrease the amount of time it takes for someone to do it manually. For example, automating the preparation, integration of customer invoices. And another example is requiring clients to make online payments versus check payments.
Consider how current events will affect your business. The global workplace has seen massive shifts in human capital and ESG considerations in recent years, and the sooner you incorporate them into your business strategy, the more chance you have to leverage their opportunities to provide top-line growth to your organization. ESG has become a bit of a buzzword in recent years, but it can provide valuable guidance on strategic initiatives. A strong ESG proposition, which stands for environmental, social, and governance concerns, which is essentially how your organization prioritizes doing the right thing over pure profit, can add value in multiple ways. Developing your proposition can drive top-line growth, it attracts more B2B and B2C customers, cost reductions by lowering resource consumption, and productivity increases. It boosts employee motivation and attracts top talent through greater social credibility. Changes in human capital and global workforce. Attracting and retaining top talent creates massive value to any organization. If you are offering remote work, make sure you have a plan to support that work with adequate investments in technology and data protection. Also consider whether inflation will require you to increase pay for your existing team or new hires. Make sure that is reflected in your budget.
When working with our clients, we always consider long-term plans. If you wish to sell or exit the business in the next 3 to 5 years, that requires additional planning beyond a general desire to improve the health of the organization. If you are launching a new product or want to scale the business by 25%, that will all need to be considered and different factors integrated into the plan. For example, I had a client who wanted to exit his business. What we did for him is we prepared a multi-year financial forecast that was for 3 years to ensure that the revenue growth was realistic, that his gross margins and net income improved over that time, and that he could build the necessary infrastructure to support it. Think about protecting your processes and your confidential information by potentially looking at IP protection. In addition, ensure that your financial ratios such as working capital, debt to equity, etc. are good and improve over that time period.
Many of our recommendations today will ensure that you are ready for your income tax return preparation, but more than just income tax returns, be prepared for 1099s, get your W-9s on file, Estimated payments. Make sure capital is available to make those payments without affecting your operating expenses. And industry-specific compliance requirements. You may be subject to sales tax, excise taxes, LLC fees, or other regulatory reporting requirements. Make sure you and your team are aware of the requirements and the deadlines so you file on time.
How not to get overwhelmed? Start early. Start now. Decide what are the most important indicators of your company's health and begin there. Don't spend too much time on things that don't mean anything to you. If a reliable source tells you that a particular number or metrics should mean something to you, take the time to learn about it, then make your own decision. There are best practices, but there isn't a one-size-fits-all finance strategy. Get help. If you are not numbers or finance-oriented person, leverage other people's skill sets. A great finance partner can save you time and stress and provide meaningful feedback on your organization's health, risks, and strategic initiatives. We can help. Contact us at 858-283-1234.